Great, so here we go. Welcome everybody. It's Stuart here from HotForex. This is our risk and money management webinar, and let's all hope we can all learn a wee bit or two from today's session. So, usual admin before we get going. Any issues with GoToWebinar or problems with audio or video, please try checking your end and try reconnecting to GoToWebinar. Any questions you have, or if I speak too quickly or don't explain anything clearly, please email me at webinars@HotForex. Please put the questions in the question box as well while we try and deal with it live as well. I'll get through it as quickly as I can and clearly as I can. So welcome everybody and thank you for your time today. Disclaimer, the material here is provided as a general marketing communication for information purposes and does not constitute independent investment research. Nothing in this communication contains or should be considered as an investment advice or investment recommendation or solicitation for the purpose of buying or selling of any financial instrument. All information provided is gathered from reputable sources, and any information containing an indication of past performance is not a guarantee or reliable indicator of future performance. Users acknowledge that any investment in Forex and CFD is characterized by a certain degree of uncertainty, and that any investment of this nature involves a high level of risk for which the users are solely responsible and liable. We assume no liability for any loss arising from any investment made on the information provided in this communication. And finally, this communication must not be reproduced or further distributed without our prior written permission. So risk comes up quite a lot in our disclaimer, and risk is very much part of this business, but risk is around us every single second of the day, so we just got to deal with it and manage it. There's a few new names in here. A lot of you guys I recognise, so welcome back everybody. Thank you. My name's Stuart. I'm one of the market analysts here at HotForex. I've been trading my own money for 20 years, and risk management is probably one of the top things that I spend as I said at the beginning, exercise my time and effort and energy on. But my approach is all about, if it's probable, I tend to do it. I try to keep things as simple as possible. I look at multiple time frames, but most importantly I know myself, and that's absolutely critical if you want to move forward. And risk management was one of the things I got wrong when I started, and I still get wrong from time to time, but you know, we were always constantly learning, aren't we, in life? So you've got to understand yourself. And one of my big problems when I started was I wanted to be right all the time. Not so much I wanted to, winning was great, but I just wanted to be right, not actually win money. That was obviously part of the plan as well, but I just like being right, and that's because I'm a bit of a big head when it comes to my personality traits. So I'm a bit of a know-it-all. I like to say I told you so. I'm one of those pains in the neck. But until that dawned on me and I realised that's how I am, and it affected my trading, I didn't really move forward. And when that light bulb went off in my head, I definitely moved forward from that as well. So knowing yourself is absolutely vital, and risk management. It's some very, very simple maths. Now, at the end, I'll go through my 1% scenario, which I'm sure many of you, I hope all of you, have seen the Mind Games webinar. Can I just ask that? Who here has watched the Mind, or has not watched the Mind Games webinar? Has anybody not listened or watched the Mind Games webinar presentation? Ibrahim, go and find it. It's on the past webinars. I'll touch on it a bit today, but definitely go and have a look at it, because it's fundamental to understanding yourself and getting off first base when it comes to risk management. There's only Ibrahim. That's reassuring. Or you're all just being shy. Don't be shy. Markets aren't shy. Markets will take your money. I have not. Well, go and find it, gentlemen, ladies. Definitely. So today we're going to look at risk management, money management, why it's vital and it's critical. I can't use any more, adjectives to describe how important it is in my view. And all the professional traders, all the successful traders over the years, over the last hundreds of years, 100+ years that have been trading, they all talk about risk and money management as being absolutely fundamental to their success. It's the difference between success and failure. You can have a really good system or a really successful approach, but if your risk management is poor, or you tend to slip into the gambling mindset, you can very easily empty your account out. Most people risk too much, and that's why they lose, and then they give up because they've got no more money left, or they think they can't do it because they haven't given themselves enough time to do it, because they've risked too much when they first started out. It's like anything in life. You know, you learn to walk before you start to run, don't you? You learn to ride your bicycle as a young person, a boy or a girl, before you learn to drive the car. That's just how life is. You know, you move out of your mum's bedroom in your mum's house before you buy your own flat or your own house. That's just how life is. So don't rush into this. This business is a marathon. It's not a sprint race. Okay, so the difference between success and failure can be very, very thin, and risk management is quite often the reason for it for many times. And use it as a positive. You know, lots of people say to me, "Oh, it's a negative. I have to think about it. I'm trading. I'm a scalper, and I can't think about where my stop loss needs to be or my take profit. I just get in and hope it'll win." Well, the word hope we don't use as traders. Okay, use risk management as a positive, and we use it in a strict, disciplined, and pre-planned way. It's part of a successful trader's, you know, armory. You know, if you think of all the arrows you've got in you, if think of yourself as an archer, you want to hit the target. Well, risk management is one of those key arrows that will really help you hit the bullseye when it comes to trading success. Okay, it really should be used in a positive way rather than as a negative drag on, holding you back. Any idiot can press buy or sell. You know, the skill is knowing when to get in and when to get out. That's what trading's all about. Flicking a coin, tossing a coin is gambling. Going to the casino is gambling. The odds are in the house's favour. With trading, we decide what the odds are. We decide when we get in and when we get out. We make the decisions. When you go to the casino, it's all down to the house. They decide, you know. Anyway, more on that in a bit. So those of you that have watched the Mind Games webinar, you'll recognise this slide. You know, remember the Mind Games where I talked about why we lose. So in the Mind Games webinar, we talked about 10, 12 things why people lose. And one of the key ones is this one here: we risk too much, like I've just mentioned already. And typically, it's that you end up risking 10 or 20% of your account on one particular trade. So that means that you're in business for, you know, you only get 10 chances before you're out of pocket. Simple as that. If you risk 10% on each trade, you get 10 chances. If you risk 20% on each trade, you only get 5 chances before it blows. Risk 1 or 2%, you get 50 chances or 100 chances before you empty your account. It's that simple. It really is that simple, and most people just don't get it or don't accept it. Honestly, you've got to understand this, write it down, and that's it. The rules don't change. The rules of maths and probability don't change, because you'll end up fighting yourself. So there's 4 key things with risk. You want to accept it. You've just got to accept that everything we do in life, there's an element of risk to it. Like the disclaimer said at the beginning of this presentation, trading is risky. Trading Forex and CFDs is particularly risky because it involves leverage, it involves margin, it involves lot size. And if you don't understand any of those things, the market will bite your bum and take your money off you. You owe it to yourself. It's your money. Not my money, not the broker's money, not HotForex's money, not whoever else you're trading with, not anybody else you might listen to telling you what to do or how to trade. It's your money. Respect it. Treat it like a business. Because the market does 3 things. It goes up, it goes down, it goes sideways. And if you're the wrong side of any of those moves, it'll take your money off you very, very quickly. So you've got to accept risk. It's vital to be able to accept the consequences of losing, because most people can't accept losing, and that's one of the big things that they end up emptying their account about as well. They want to win all the time. They've got to win all the time. And as I say all the time, and I'll show you again in a few slides time, some of the best traders I know, and the best traders on, when you look at their records, they lose a lot. They lose an awful lot, and they accept that. You've got to avoid risk as much as you can. As I say, too much risk will empty your account, so try and accept it, but also avoid it as much as you can, or reduce it, certainly. Larry Height's 1% rule, which I'll show you at the end. And again, those of you that watch go to the Mind Games webinar, I'll talk about that as well at the end, and I'll go through it again today. It's very, very simple. Most people say it's not true. Well, it is true. I've yet somebody to actually prove to me mathematically that it's not true, but that's just the way it is, and you can be successful by risking just 1%. Too many people in this business, again, are in too much of a rush, and the market, you know, as I said before, will take your money off you very, very quickly. So accept, avoid, reduce, and transfer. So don't have too many correlated trades on at one time. Don't be completely long the dollar, except for times like now when it's going up. So it's just, you know, be careful. Don't overstretch it. So that's what I would say. So transfer your risk, reduce it, avoid it as much as you can, but accept it as part of the business, and part of losing is part of risk management. Many people I speak to day in, day out have the thing turned the wrong way around. They are worrying and concentrating on winning, being profitable, winning, making money, capital appreciation. Turn it around. You should concentrate and focus on hanging on to what you've got. You know, whatever age you are out there, it's taking you a while to get the money that you've got to invest, unless somebody's given you, you know, it's fallen out of a tree or something. Capital preservation is by far the most important thing, and again, the thing the professionals, I know I'm talking about professionals, I'm talking about guys that work in you know, these big banks we've all heard of, Citibank, Goldman Sachs, the guys that run these big hedge funds that are talking about dealing with billions of dollars, trillions of dollars, some of them. They focus on capital preservation, hanging on to what they've got, not trying to make money. The making money comes from doing what they do well. They preserve what they've got, and their money grows because they know what they're doing. Okay, you've got to accept losing. And again, I, for the sake of repeating myself, I'm not going to apologise, but it's the same thing, and I say it all the time. If you take some small losses and keep your losses small, even if you have many small losses, you know, you want to make, it's the big winners that make you profitable at the end of the day or the end of the month. So, you know, lose the battle to win the war, as they say, or lose many battles to win the big war, the big end game. The end game is to make money at the end of the month, or the end of the week, or the end of the day, or whatever it is your time frame fits with your personality. And again, that's something I talk about a lot in the Mind Games webinar, where it's because it's all about you. If you don't manage your money, I'll be completely brutal, you're just a gambler, go away, go to the casino, don't try trading because it's not for you. The number one reason traders fail is this lack of understanding of money management or risk management. You know, it's very simple, but too many people just don't, either they'll give it sort of lip service that they understand and accept, or they'll understand what trading with a full lot means in terms of their account, but they don't really understand. They haven't really got enough capital in their account to justify trading with one full lot, the size of it. And again, obviously, all, you know, the beauty of brokerage and forex trading and growing and all sorts of other asset trading is it's allowed people with small accounts, ordinary guys like you and I, to get in and play with the big boys. You know, a full lot is $100,000. Most of us haven't got $100,000 to risk on one trade. Well, that you would need that if you were trading with no leverage, and leverage allows you to do that. But you really must understand leverage inside out if you're going to be successful at this business. So lot size, leverage, margin, pips, spread, all that sort of stuff, all those basic stuff, and be sure you understand it thoroughly before you risk a single cent of your account, because without good risk management and not understanding leverage, you very quickly empty your account. You can understand a bit about leverage but not apply risk management, and again you can still empty your account. So there's lots of ways of being tripped up, and the market can take your money off you. It's yours. Look after it, respect it. So stay on the right side. So what's the difference between trading and gambling in a casino? I'm going to stop talking now. Somebody put a question answer in the question box. I've sort of touched on it already. What's the difference between being a trader and a gambler that just walks into a casino with his $1,000? Anybody? Anybody fair to give me an answer? I'm going to have a little sip of coffee while I wait. Oh, you're all very shy today. I don't normally expect that. Where's Omid when I need him? So, in my view, well, not in my view, the view is, as I said at the beginning, Gambling in the casino, you walk into their premises. They're in charge. The blackjack tables, the roulette table, the roulette wheel. You're down to there. The risk is all there. Here, thank you, Francis. I've never been in a casino, Francis. Okay, well, that's fair. Just what you imagine a casino, what gambling is. Okay, trading, the risk is calculated. Absolutely, CeeLo. That's absolutely nailed it on the head. When trading, we decide when we enter and get out. With gambling, the house has the odds in their favour. Absolutely, Bruce. Absolutely nailed it on the head. Gamblers work with luck and not a strategy. From Ali. Well done, gentlemen, ladies. Thank you very much. Yes. I started to speak too quickly. So absolutely, that's exactly right. We have the cards in our hand, in our favour when we're trading. When you want a casino, it's not. So it's but you've got to understand these simple numbers. Sorry about all the words on this slide, but I couldn't make it any shorter, and I wanted to try and put it all on one slide. So let's just read through this together slowly. So simple numbers, simple math, simple probability. So let's go back to the old, whatever it was, grade 3 or 4 or whatever it was when they first started introducing probability in your math lesson. It was the old flicking of a coin. Everybody's got a coin. You know, we flip a coin. Say we start with $10. The basic premise is you have a 50% chance of winning, don't you? That's right. So the gambler or the trader thinks, well, the chances of me having 10 losing chances in a row, i.e. coming out heads or tails or whatever against me in a row, is very low. Well, a couple of times you might be, but over time, you know, you do this 100 times, 1,000 times, 10,000 times, you won't be. You know, you will have 10 losing bets in a row. The coin, remember, an equal coin, equal balanced coin, does not remember the previous heads or tails. They're independent events. And I forget the there's a probability event. So each each event is a new event, and there's a phrase I should have put in there. I can't remember what it is now. So inevitably, statistically, you will get these 10 losing trades in a row. And remember, those of you that follow me on, come to the Tuesday live webinar, live trading events. Remember, I had 7 or 8 losing trades in a row back in whenever it was, in April, wasn't it? Remember. And that hasn't happened to me for 18 months, but it does. Over time, that will happen. So if you're risking too much, it's a very quick way of emptying your account. So just going back to our $5 stake, and we're doubling our stake each time, that $5 stake, you end up losing, $2,500 very, very quickly. If the same player, and this is what tends to happen with people trying to double up or catch a falling knife, as we call it in trading, they're losing, so we'll double up their martingale approach. Very, very quickly, 2,500 suddenly turns into 9,700. Now, this is clearly somebody who doesn't know what he's doing, has no respect or understanding of risk and money management. Okay? Understand the numbers, keep it simple, keep it on your side. Okay, so back to the casino, or even you don't have to have been in a casino to understand this. Now, second question. I go into a casino with $100. I bet $5 on red. Each spin, I double my bet each time. How many times does it have to come up black on the casino wheel for me to end up out of money? So each time I lose, I double my bet. How many losing bets in a row do I need before I've run out of money? $100. Bravo, Bruce. It's 4 and a bit. Yeah, 5 really. But Francis, go back to maths class. 20. Right, let's just do this. So you bet 5, so your 100 goes down to 95. So you double it. Then that's 10, so you take 10 off your 95 and you're down to 85, so you've had 2 losing trades in a row. The third losing trade, you double it again to 20, we're down to 65 now. We lose again, we double it to 40, and we've got $25 left. So we're out of money after the 5th, or we don't even get to do on the 5th bet, we can only put what we've got left, which is $25 left. So very, very quickly, that sort of approach, you end up out of pocket. So understand, Francis in particular, you put 20 there. Understand the numbers. If you don't understand them, email me, ask me. Hopefully the little spreadsheet I'm going to put up at the end will make sense to you. But it's all about simple numbers. and understanding the probability of success. Okay, as I said at the beginning, this is your money, respect it. That's what the big boys do. So think like a big boy, think like, you know, a serious player, because it is serious. This is a serious business. You can make serious returns, both percentage and in real terms, but there's no rush. Okay, have a plan, have a strategy that makes sense for you. You know, there's no, as I say, again in the other webinar, I keep talking about the mind games webinar. There's no point in trying to have a strategy that doesn't fit with your psychological build-up. That's why, again, I talk about in the books. I talk about looking at trading psychology. It's just as important as risk management. Another very absolutely vital part of successful trading. Don't trade impulsively. Don't try and think the market owes you because you've had 2 or 3 losing trades. Don't double up. Don't triple up. Stick to your plan. If the plan isn't working, stop, reassess, reevaluate, write everything. That's what I say. Always say as well, write everything down, understand it. You know, a good trading day doesn't have to be a profitable trading day. You know, you could learn something every single time you press buy or sell. You know, the old adage, you know, scared money never wins. You know, trade what you can afford to lose. All those sort of things, they're all true. They're all old cliches, but they all make sense when we're looking about risk and dealing with our risk ourselves. So try and automate things as much as possible. I'm not a great fan of EAs. I'm not a great fan of robots. I haven't found one that works over a consistent period of time without making huge losses or having massive drawdowns. Oh, sorry, big wins and then big drawdowns and far too much volatility, and getting stopped out or getting closed out. So to automate things as much as possible. Your ins and out. Always trade with a stop loss. Always trade with a take profit. Know how much you're going to lose when you do lose, because you do lose a lot. Know how much you're going to win when you win, and treat both of them emotionally the same. Accept losing. Manage your emotions. It's very difficult, but once you get there, it becomes much easier. And there's all sorts of tricks and techniques I talk about doing it with all these different things. Okay, some of them are just you've got to do them. And I look at many accounts where people say, well, I followed the rules, and I look at them and there's no stop loss, no stop loss, no stop loss, no stop loss. He closed his trade out when he was 2 cents up, but he let his loss run to $20. I see that time and time again, day in, day out. Have a strategy, have a plan, stick with it. Okay, make it work for you. Again, come to our live webinars. You see my day, the way I trade on a at the end of day process. If you only want to trade at the end of day, you have a look at the 1 hour the 1 hour strategy. It works very effectively, but again, you just got to wait till the hour's up and wait till the two or three very simple rules are ticked. Too many people jump in and try and trade too quickly and too aggressively for the size of their account and for their personality. The one, you know, there's loads. I talk about loads and loads of books. Jack Schwager's new Market Wizards. He first wrote back in the mid '80s, and it was literally, as it says here, conversation with America's top traders. And these are serious guys. These guys are making billions. Okay, and what their number one rule that comes through all the books that Jack Schwager's written in this the Market Wizards series, there's lots of them now, is risk management. Have an edge. But risk management, ruthless risk management, I think they talk about. They all of them, all independently. They don't obviously. Some of them are very shy, reluctant people. They don't want to be on Bloomberg every 2 weeks or whatever. You know, pontificating about their markets and what they do. A lot of them are very shy, introvert types. Some of them are very extrovert types, but a lot of them aren't. They're just very nerdy types that just like to make money and do and money simply being an energy to let them do other things in life. So, but the one thing that comes through all that series of books is risk management is key. And any trading strategy or plan or element you put together, it's the 4-legged stool or 3-legged stool. Risk management has got to be one of them. So my system really talks about trends, changes in trends, changes in energy. Getting in, getting out. So I've defined entries systems, get out systems. My targets and I use the ATR. But the key thing of my particular strategy is this one here: strict money management. As I've said to you, I think I've said in the seminars, I don't know if I've said it on webinars, but My system itself, if you look at the code of the lines that I've written to actually do the trading bit, the risk management number of lines is nearly 3 or 4 times longer. There's about 100 and odd lines of code about the risk management side of it, and that's fundamental, and that's why I bang on about it all the time, because it's fundamental for me and my system, and it works for me. And so and from what I understand about other people and other people's strategies and approaches, it works for them as well. So, how much do we need to break even? Each trade, you assess the risk of each trade. How much capital, how much money do you want to risk per trade? I normally talk in percentage terms. What are the costs of the trade? Every cost, every business has a it's all about profit and loss. It always has a cost. Every trade has a cost. The price you get in, the price you get out, any commission, any rolling costs, any other costs. That's all part of your profit and loss account. Make sure you're writing it all down. How long do you want to hold a trade for? Some people are scalpers, they're in and out in a few minutes. Other people might hold it for a few days or in a few weeks. What's going to happen over that sort of time? What's the downside? Does it satisfy my money management criteria? Does it satisfy my risk reward criteria? All these sort of things, badge them all together, and this all makes part of a good system on whether you take that trade or you don't take that trade. The other art of good risk management and good trading is knowing when not to take a trade. You've got no margin left, or it's going to take up too margin. The trade's going to take too long to get to target. The target's too realistic. The stop loss is huge. It's going to gobble up too much margin. Oh well, never mind. I can't reduce my lot size to make it viable for me to take that trade because I haven't got enough in my account. Never mind. Write it down. Did that trade work out? Did it not work out? Just because you didn't take it, you haven't made any money or lost any money. It's still a piece of education that goes into your trading manual. That goes into your trading encyclopedia. So, key things. Most successful traders, it says there, doesn't it? Not traders. Most successful traders are wrong a large percentage of the time. I'm wrong a lot of the time. 30. I do quite well most of the time. It's like 30%, 31%, 34%, something like that over the last 18 months. But that's still quite a significant amount. And as I'll show you in a minute, those of you who have not seen the previous webinar, you can be wrong 40, 50% of the time and still make money. That might sound absolutely crazy. It doesn't make sense logically, but it's true. And that's why trading is such a one-off, such a unique business, a unique opportunity, because there isn't any other business or any other job in the world where you can get things wrong 40 or 50% of the time and still be very successful at the end of the month. If an accountant, a banker, I don't know, an airline pilot, whatever, a doctor, a nurse got things wrong 40 or 50% of the time, they wouldn't have a job after 2 or 3 months of that sort of performance, would they? Whereas in this mad business you can, and the issue is it's not the 60% winning, it's the 40% losing that you have to deal with. Because successful traders limit their losses, whether it's in the percentage terms, which is the easiest way to do it, or in actual absolute dollar terms. They accept they will lose, but know at the end of the month or the end of the week or the end of their trading horizon they will be profitable. And they use a risk-reward ratio that works for them. My spelling's been terrible on this slide. That's tarders and fro, and that should be 4. Many people, the textbooks and many people say, oh, you need a risk-reward ratio of 1 to 3, 3 to 1. For me, quite often it's less than 1 to 1, but because of my system, I know it works over time. It works. I can't advocate that to most people because logically it doesn't make sense, doesn't it, having a risk-reward ratio of less than 1. But for me, 1 to 1 is good enough, and sometimes less than 1 to 1 because of the way my system works, and it does work for me. So look at these levels, what we've seen recently, for instance, these strong trends on the dollar, I've just, again, those of you who've been following me on the live webinars, I've just been adding to these, instead of getting out at target 2, I've just been adding, because the trend's still well established, I've just been getting back in, having taken the profit I wanted, and then just let the trade run until the trend runs out of steam. And so some of them we've gone from targets 1, 2 to 3, 4 and 5 targets on some of these strong trends that have been established over the last month or so. So that's obviously helping my risk reward ratio tick up a bit. So these are some of the key things that successful traders do, both professionals, retail traders, guys in big banks and guys in big hedge funds. This is just a slide I've taken from a typical, and there's lots of these around, you find these yourself, but this is a typical risk reward sort of win-loss ratio, looking at win-lose ratios, risk reward, starting with a 5,000 capital, risk of 3% per trade, given $150 per trade. So this is the win-loss ratio. This was the guy's where I took this from. This is the book that this was his. He was about 3.5 to 1, winning about 60% of his trade. So he's doing, he turned his $5,000 at the beginning of the year into $25,000 at the end of his trading system. Again, these are very, very simple Excel spreadsheets you can create yourself. You can have a copy of the one I'm going to show you in a minute. Very, very simple, and you play with it yourself, see how you fit. You can do all this on a demo account. You don't need to risk with a real money account if you're not comfortable doing that yet. If you haven't found a strategy that works for you, just get something that works for you, because there will be something out there. And the reason, the reason most people fail is they'll risk too much. They'll try and do something that doesn't fit their personality, or they're in too much of a rush. And you combine all those three things, and they end up emptying their account very quickly, and then doing it again, and then doing it again, because they haven't learned anything from it. It's a marathon, not a sprint, and just understand these simple numbers, and obviously the other things of leverage, lot size, and margin, and account size, absolutely vital as well. Okay, so let's, those of you that have watched the previous webinars, I'm sure you've seen this before, but I'm not going to apologize for doing it again. This is all about this is from the mind game webinar, these last few slides. So do what's probable, So let's go through what we've just had a look on that previous slide there. I don't know if any of you want to take screenshots of that, but that's quite a good, I quite like that one. But this one, I'm just going to walk through this one a bit more slowly for those of you that perhaps didn't grab what was on that final side. So let's assume the 1% rule. So with an account size of 5,000, risk management says we lose 1%. So 50 is 1% of 5. Let's assume on here we do 2 trades a day, which is 10 a week. Actually, this is out of date now, isn't it? That should be 400. It's an old one, this one. But anyway, okay. So 10 a week, 40 a month. It's 480 a year. That's the rather than 520. But anyway, the math is still the same. We win that. Say we win 60%, 6 out of 10. So that means we want to have a win risk reward ratio much less than was on that previous slide, but we're happy with 1 to 1.5. So we lose 50. 1.5% is 75. So it's still twice as much as we're half as much again as we're losing. Okay, but we're winning 60% of the time. So here we end up. These numbers are wrong. Oh, anyway, so here 60% of 480 gives us a winning amount of 14,400. A losing amount gives us 9,600. So the point is, basically, this is my point, that we still end up 90% or nearly 100% better off than we did at the beginning of the year, 8% a month. So we're winning 400. The difference between the two, 4,800 a year, which gives us 400 a month. We start with 5,000 our account size, so 5,000 each month. 400 each month of the 5,000 gives us 8% per month, or 96% per year if we times that by 12. Okay, so some people say, well, that's let's prove your 50%. Well, here's my 50% argument. We can still lose half the time here. Have a win ratio where 1.2%, only, instead of winning 75, we win $60, losing $50. We still end up with another 50% of our account, 48% of our account, if we can stick to these rules of 1%, or whatever your rule is. If 1% is too tight for you, make it 2% or 3%. But you just got to bear in mind that each time you tick this rule up, it's putting more pressure on your winnings. So stick to the 1% rules. You know, this is a very typical spreadsheet. This is what we've seen. Now I've got, if you want a copy of this to yourselves, please ask me. It's very, very simple. And the problem is, most people are over here on this side. You know, they're risking 10% to make 5% on their trades. They're winning, yes, they're winning 60%, but they end up losing money very, very quickly. And again, you know, fiddle with these. You know, even if they were, you know, risking 5% and trying to win 30%, even, you know, 6, 7, 8%, it still get caught out very, very quickly. So it's all about keeping your risk small, and these numbers do work, and you just got to keep on top of them. Know what works for you each and every time you want to take a trade. So you can either risk a percentage of your account. Obviously, as the account grows, this percentage grows. So if you're having more winning trades, instead of this, let's go back to, you know, this can increase as we halfway through the year. Our account size is much bigger, so our 1% gets a bit bigger. I haven't talked anything about compounding yet. That's the next. That's, you know, the 8th wonder of the world, as Warren Buffett calls it. This is all just simple flat maths. Compounding really, really helps. Or you say risk a percentage or risk a fixed amount for each trade, but you've got to be comfortable with this one. You've got to be comfortable with the losing side of things, and that's what lots of people can't cope with. You know, so analyze everything you do. You know, scrutinize, optimize, prepare. You know, respect your winners as you respect your losers, and you know, treat them both the same. It really is the fundamentals of good, successful risk management. And that's, you know, that's what I do. This is the sort of thing I do. This is all written down. My current risk reward. I've got the wrong spreadsheet on here, but I could bring it. I don't know if I've got it. I haven't got it actually here with me. It's on my other trading platform. But my personal current risk reward is about 2 and a bit %. It's not great, but you see, it's because I have some of my system works on some risk reward that's less than 1 quite often. But that works for me, and it fits with my approach, and it fits with my mindset and how I treat trading. Okay, because it's very much gone click in my head. So you know, it's all these things successful traders talk about. You know, the fundamentals, the news, the sentiment, technicals, yes, charts and patterns and support and resistance. But this one, as we've just talked about, is absolutely fundamental. Excuse my writing, but risk management, absolutely fundamental if you want to move forward, and just understand it, set it, and stick to it. That's the key thing. Many people talk about it, many people put it together, but then give up when the going gets tough. As I said at the beginning, right at the beginning, it can be. Oh, I'm not going to go. Oh, it's too many slides to go back. A good risk management system can be a very positive tool rather than a negative tool. Okay, that's the key thing, and make it work for you, whether it's a percentage or an absolute amount of your account. But if you don't understand the basics of leverage, lot size, spread, and all that sort of stuff, this will get lost, because you've got to have those basics ground into your understanding. Okay, and understand how leverage can be very, very beneficial, but it also can work against you as well. But when it does work against you, it's just part of the trading business. Okay, so that's really all I wanted to say about risk management today. We can go on and on and on about it today, but all day, to be honest. But here's our app. Download it. There's nothing on there about risk management, unfortunately, but it's got all the news. It's got all the indicators. It's got our analysis written on there as well. The books I talk about all the time, they haven't changed. There's lots and lots of trading books you could have, but the fundamental ones are Edwin Lever's Reminiscences of a Stock Operator, the story of Jesse Livermore, and the one we've talked about today quite a bit, the New Market Wizards and the Market Wizards. Any of those Market Wizards books are great, by Jack Schwager. And Trading in the Zone by Mark Douglas, another great book. These two are the two key ones. Lever and Douglas. This is all about trading. This is all about the psychology of trading and what I've talked about today. And within the Market Wizards books, you'll see the idea of risk management being fundamental to what they do. Okay, so any questions before we go about anything that didn't make any sense? Anybody want me to go back over that spreadsheet? Albert's just asked, in reminiscence of a stock operator, they talk about the tape. What do they mean? Remember, Albert, that this was written at the turn of the 20th century. So the tape machine they were talking about was a ticker tape machine, and it's basically, it was how the stocks prices came out. I'll see if I can, while I'm talking, I'll see if I can Google it for you, see if I can find it. It was basically a long thin tape with holes in it, punched holes in it, and that was the tape. And what Livermore and his colleagues did at the time, they could understand what the dot holes in the tape meant. So it was all about, it's not it was all about understanding who was buying, who was selling a particular stock. So these were stocks on before the US stock exchange occurred. This was on the floor of the actual brokers themselves before there was a US stock exchange. Francis asked, setting of stop loss. Do you mean how to put it or where it needs to be? Is that what you mean, Francis? Let me just... Yes, right, okay. How am I going to demonstrate that? Let me think I'll demonstrate that from the slides I've got here. Let me see, bring up a... Best thing to do is bring up a chart, isn't it? Always, when in doubt, bring up a chart. What time is it? We've still got plenty of time. It's only 1:45. So... let's have a look. Let's just bring up an example. So euro, it's a bit messy. That, can you all see that? I can't see what you can see now. Actually, can you guys? Can you all see the chart? My MT4. Hopefully you can. I'm guessing you can. Let me zoom in a bit. So, right, here's a good example actually, because that would have triggered a continuation trade here. So here, whilst I've been talking, we've missed a trading opportunity. Okay, Francis. So this is the 1 hour system. This is the euro. Just fit that. This is euro. Does it zoom up anymore? No, it's not going to zoom up anymore. So hopefully you can see what this is. So my 1 hour system, or the 1 hour strategies we talk about, the crossing would have triggered here, because the blue line here, the 5 period EMA, has crossed above the yellow line, which is the 9 period EMA, and it's also broken. The candle has closed. The white candle here, positive candle, has closed above the midpoint of the Bollinger Band. So that would be my entry. Let me actually, this is a really good example. I hope this makes sense, friends. So that's the entry there, and that's 118.74. So let's just write that down. 118.74 is entry. So this no sound, right? Enjoying the book sales, very good. How do I determine how many trades to place in a pair and protect my... Cleathan, I'll come on to that in a minute. Let me just explain this for while I'm going through this approach to putting stop losses on. Okay, right. So this was the trigger. We had the EMAs crossed, and we also crossed the midpoint of the Bollinger Band. So we entered there at 118.74. Our target is 14 pips, because that's what the ATR is at that time. See the ATR there, 14. So 118.74 plus 14 is 118.88, isn't it? So 118.88 is our target. So our target here is only 14 pips. Okay, so let's just put that on there. So 118, what did you say it was? 118.88. It would have already hit that actually. It doesn't matter. This is quite often what happens, but don't worry about that. So let's just let's make that correct. So that one, what we said, that was 118. It's 118.88. Okay, so that was our entry at 118.74. So that's there we go. We may not have closed, because remember, it's the spread might have kept us out of there. But let's assume we had. So that's our target. This system, Francis, suggests that the stop loss needs to be around where the system turns. This is what the theory says. So the stop loss, as you can see here, the stop loss is absolutely massive compared to our target. But I'm comfortable. The reason this system works for me is that, or works, is that because we're above the 5, the 9 and the 20 period moving average, and our target is only the 1480R, the probability of it getting there is quite high. Obviously it doesn't happen all the time. So theoretically my stop loss should be down there where the energy turned in the market. But obviously that's clearly, let's just change that one. That's clearly huge and risky and would gobble up a lot of change that to red, would gobble up a lot of margin. Obviously we're trading that way, that's quite a risky way of trading. From that, that's the target and that's stop. So a more sensible stop loss would be where perhaps here where the energy changed again. See whether we weren't going sideways there. So I would typical stop loss would be there. It's still less than 1 to 1, but again the probability is on my side. So that's how I tend to trade these 1 hour systems. So the stop loss, really, to answer your question, Albert, needs to Francis, needs to be where it needs to be. So theoretically it needs to be down here, but obviously in real life that's huge and it's massive. So and it makes the target ridiculous. But the way this system works is you get out and then get back in. So that stop loss would be there. So to work out what that risk would be, you would work out what that stop loss is. So here we've got 118.74. Our stop loss needs to be down here at 118.49. So that's 74 to 49. 49. So let's say 25. So we've got a 25 pip stop loss for a 14 pip gain. So again, seriously, as we've said, significantly less than 1 to 1. But what you would do then is make sure that if that 25 pip stop loss needs to be one maximum of 1% of your account. And how can you do that? Well, let's have let me bring up. Again, you don't need to do this all the time. You can have this set up automatically. Here, let me just find our. We've got little tools on our website where you could start using all these sort of things. So on the website there's a risk management tool. There's the tools. No. Oh, they're gone. There we go. So our opening price was what did we say it was? 118.74. We only want to risk say 2% of our account. Say we got 5,000 in our account for the sake of our stop loss. Where did I say our stop loss was? It was 25 pips, wasn't it? So it was 118.49 we said, didn't we? So this, with a $5,000 dollar account, only to risk 2%, we can have a lot size of 0.4%, and that's what these little risk calculators do for you. Okay. Obviously, the issue is with a smaller account, if we only had 500 and we wanted to collect 2%, it wouldn't let us. No, it shouldn't let us trade. That's not. Why hasn't that worked? We'd have to increase the risk on that account. That hasn't worked, has it? That's why it's so there's all sorts of little risk calculators to be able to help you to do that. Clethans asks, how do I determine how many trades to place on a pair and protect my margin at the same time? Protect my margin. How many trades? Clethan, it's all to do with exposure at the time. Let me take that off. To do with exposure at the time. So you want to be exposing no more than about, maximum of 10% at once. So if you're going to lose 1% on each trade, let's say all 10 went wrong, you'd lose 10% of your account. Okay. So maximum, again, it's how you want to manage the number of open trades. For me, I've been in the position I don't like to have more than about 10 trades open. Recently I've had 10, 15, 18 trades open, and I've got uncomfortable, and that's affected, and that tends to affect sometimes your decision making. Even though my system's very automated and I just follow the rules, and there's lots of margin and there's big account size and stuff, it still affects you when you've got too many accounts open. Okay. What leverage would you suggest to be a safe leverage? Albert, I can't tell you what to do. I'm not allowed to do that. Leverage, you understand it and appreciate the benefits of it and the cons of it, okay? And the account size that you have, okay? I'm not allowed to tell you what to do or advise you what to do. Does this mean the smaller the account, the more hectic to grow? Take, for instance, a $100 account using 2% risk, you mean limited to a lot size of 0.1. In a sense, Ali, absolutely. A $100 account is very, very difficult, in this business. Okay, that's a very, very small account. You shouldn't be trading more than minimum lot size, even with a few $1,000s in your account. It's still quite risky. Just think about it. Just think about what you just said. ATR is important. ATR, Francis, is basically how I work out the targets on the system. So I always have the ATR here. This is watch the live webinar, recording of the live webinars, Francis, if you want to see how the 1 hour system works. But I use the ATR as the target. So and once a trend's running, it can run very, very well. So for instance, this trade here, say we'd taken this trade at 2 o'clock, it's already hit target. So at 3 o'clock, when in the next 5 minutes, I'll make a decision, or you would make a decision if you were trading this. Is this trend still running? Well, it's quite strong, but it's not great. It looks like it's pushing up, but it's already gone through. This yellow line is the pivot point of the day. I also have the pivots on here. But remember, it's against the trend. It's because the euro's ticked up here against the dollar. The dollar's being very, very well bid. So is this still going to run? Well, it's had 2 good up hours. Is it still going to run again? And again, you'd make that decision at the close of the hour. Here, as we were coming down, it's the same thing. Here, this one, for instance, let's just do this as an example of what's already happened. So here, the yellow were crossed way back here, but there wasn't a big enough, and we were under the midpoint of the Bollinger Band still. So the initial entry would have been there at 7 o'clock in the morning. And then the target would have been down here somewhere. I don't know whether you'd actually been hit or stop loss would have been up there, so you might have been taken out. Who knows? But the big entry would have been this one here, because this is the energy, and this is later in the day. This is 12 o'clock, so your entry would have been there, and then you would have traded this one down to there. That's the next. I think that's the actual. Oh no, that's not what I'm talking about. That's that. So whatever that was, the ATR at that time was. It was about the same, wasn't it? It was about it was a bit more. It was 11 pips. What time is it? 5. Still got 5 minutes to go. So that would have traded down. So when the time we got to those actually that's the same, isn't it? No, sorry. Yeah, so 18. Yeah, so that is virtually the same. So you would have touched out on that, and you would have entered it again there, because the trend there was nicely aligned. We've got the yellow, the green, the yellow and the blue all pointing down nicely. So down we go again. So you'd have entered there, and you would have had another entry on that one as well, and that would have taken you down. So there's 3 in a row there. That trend's unwound. This one has only just triggered at this one. So as you can see, as the hour's closing here, you can see how this one's suddenly turning around. So we got to our target. This might be just a one-off. 14 pips or so on that one, so it doesn't look like it may be going. So you might want to wait an hour to see if this is going to start to move up again before we move into it, and that's how the trend unwinds on that one. That's why the ATR works so well. Francis Albert, as a beginner, what's the appropriate amount of account equity that should be invested? Felix has asked that. Again, Felix, I can't recommend an amount, but if you do the numbers that I've talked through, I'm not allowed to tell you exactly but you should really, invest as much as you possibly can without it affecting your daily lifestyle. Okay, because if you invest too much that you're worrying about, paying the rent or paying the mortgage or putting food on the table, that's just going to that's just going to nag away, and that's going to stress you out completely. Don't do that. Don't invest more than you can afford to lose. Think of it as an invest. If you're a new trader, think of it as like going back to university or going to school again, paying for some education. People pay for courses, people pay for these sort of webinars. We give them for free, so just use your account as like an investment in you. And if you lose it, it's not the end of the world. It's obviously not great. I know what it's like to empty an account. It feels horrible, but it's part of a learning process. And just if you write stuff down, you'll be amazed at how quickly you'll start to feel the market. You'll feel certain instruments that work for you. You'll get a feel for certain currencies or certain assets like oil or gold or the euro yen. Some people trade just the pound yen, or some people just trade the cable exchange, because they feel a particular currency and know how it might move during the day or during certain news releases or whatever. But that all takes time, and to be able to get experience with real money, it all comes back to risk again. Because if you're not risking very much and you lose a lot, it doesn't matter, because you're only losing 1 or 2% of your account each time. Yes, it matters because you're losing, but you're getting the experience of actually doing real trades with real money in real time. You're not still on your demo account. So somebody's asking me what my trading style. My trading style is at end of day. Most of my real cash is risked at the end of the day. I wait till the daily candles close. My system triggers on that. As we can see here, the 1 hour system works pretty well as well, and this particular setup works quite well on 4 hour time frames as well. So you can use it. There's lots of different profiles. So we got it here on the 15-minute and up on the higher time frame. So if you're working, if you're out a lot, or if you're working and you can only look at your account during the day a few times, the 4 hour candles are great, because you only get 6 of those a day. So you need to actually look at the charts 6 times a day or 4 times a day. 6 times a day, isn't it? What am I talking about? Going mad. Window, so tile. So again, this is exactly the same setup. Obviously, there's pros and cons to each way. You've got to wait. Have you got the patience to wait all this time? But the beauty of the 4 hour time, obviously, the ATR, the targets are much bigger, the stop losses are much bigger. But that's how you want to trade. How do we join your live trading session? I didn't know about it until today. Ali, it's the Tuesday webinar. It's always at 11 o'clock. Every Tuesday we do live trading analysis. I'll show you what I've done over the last week, and we update any stuff. And on the Facebook page and on the analysis page, we update any things that might have changed the night before for stuff that day or each day as well. So have a look on the Facebook page as well. Okay, time's nearly up. But any final questions? Anything about risk? Anything about anything at all? I hope I've explained things clearly. And I say I can't emphasize understanding the basics. For a lot of you are new traders here enough. So certainly watch the Mind Games webinar. Go through this webinar again, and certainly have a look at the. I've got the website up. Where's it gone? I've got the website up. Make sure you have a look at the. Again, if you're new, make sure you have a look at. Let me get rid of that. Here. Where's the education page gone? It's disappeared. Should all be on the same page, shouldn't it? Have a look at the education page here, and make sure you go to the videos, and certainly look at those first two. Certainly, if you're trading cryptos, you understand the background of crypto. But this one here about balance, equity, margin, lots, pips, all that sort of basic stuff. Watch that. Watch it again. Send me a message or email me. Send me a message on Facebook or Skype or whatever. If there's anything in there you don't understand, but this, you need to understand this 15-minute video before you risk a single cent. Then you apply things like risk management, finding a strategy that works for you, and then you invest, and then you trade your own real money. Okay, so have a look at that video. I might update it a bit and split it up a bit, but and there's all sorts of, there's loads and loads of stuff on there about trading and the MT4 platform, but we're here to help basically. So any final questions? I'm going to go now. I need a cup of tea, drink of water actually, I think, more than anything. Ibrahim, very good. Watch the Mind Games webinar, Ibrahim. Okay, all the best everybody. We'll see you again tomorrow. Otto's talking about. It's just past me what he's talking about tomorrow. I can't remember what he's talking about. Was it support and resistance tomorrow? I haven't actually got it on this system here. But anyway, join Otto tomorrow, and we'll see you all again. I'll see you all again next Tuesday for live analysis. So thank you very much. Email me at webinars@hotforex.com and we'll be in touch. Okay. All the very best, everybody. Thank you very much. See you again next time. Bye. How much risk I trade per trade? 1%, Raheem. Try 1% of your account. Okay. Take care, everybody. Bye bye.